as the U.S. stock market is hitting all-time highs, there's a cautionary tale for all of us taking place in Asia. Recently, the Hong Kong stock market had its largest drop since October of 2008. That was during the great financial crisis when the U.S. stock market, top to bottom, the S&P 500, dropped 60%, 60%. Am I saying that's going to happen in the U.S.? No, I'm not. But I think there's some lessons here that we all can learn. So let's jump in. Newsweek was reporting Hong Kong stock market suffers its biggest single-day drop since 2008. Bloomberg jumped in as well. The crazy Chinese stock market swing ignites the biggest ever trading frenzy, and the turnover in mainland in Hong Kong jumps to record, and the benchmark gauges in Hong Kong slumped the most since 2018. So what's behind this, and is there things we can learn? I do think there's things we can learn. So let's jump to the Carnegie Endowment for International Peace. Their Carnegie China group published a commentary piece, Why It's So Hard for China to Boost Domestic Demand. Now, why am I pointing this out? I'm pointing it out because there's some engineering taking place in China, and frankly, there's some engineering taking place in how we're boosting the stock market here in the US, right? The Federal Reserve just went through a big case of rate hikes to slow down inflation. We saw that worked. The latest CPI numbers just came in. We're becoming more and more contained in inflation, which is a great thing. But there is some engineering, there's some strategy taking place in the US, and a little bit of that is a very good thing. Too much of that can be a bad thing. So let's see what we can learn from China. So this article by the Carnegie Foundation, it's Michael Pettis, who's a non-resident senior fellow at Carnegie China. And he says that there's a near unanimous consensus that's developed among Chinese and foreign economists that consumption's very weak role in driving the economy is the main constraint to China having a sustainable economy. And that's important because we want to see the underpinnings of any economy being based on something that's sustainable. And based on the comments in my videos, a lot of people are feeling, hey, Azul, what's driving the US stock market is not sustainable. It's additional stimulus, it's tax cuts, it's things that, it's our increasing deficit, it's things that are going to continue until it doesn't. So let's continue with this article. Globally, according to the World Bank, consumption accounts for roughly 75%, 3/4 of GDP, with the remaining 25% driven by investment. This is for most companies, most countries, most developed countries. In China, however, consumption accounts for 53 to 54% of GDP, while the rest, an astonishing 42 to 43% of China's GDP, is accounted for based on investments, things into infrastructures, things into business. And in early June, American economist Paul Krugman publicly worried in a Bloomberg interview that China's leaders were bizarrely unwilling to use more government spending to support consumer demand instead of production, right? I mean, China's primary ways of making money and supporting and propping up their economy is making stuff for the rest of the world, right? And that's slowed down because of their zero COVID policy. That has slowed down. Obviously, many countries now view China as maybe in the future a potential enemy. So there's reallocation of capital to other countries for some of the manufacturing. So the article goes on to say that there's three main reasons that the consumer spending is not solid in China. Again, we're going to come back to the US and what we can all capture. At first is a strictly managed credit system that ensured Chinese savings, which by 2000 had the highest share of GDP ever recorded. So the Chinese, the Asians, are much better at saving money than we are here in the US. But their savings is mostly controlled by government-controlled banks, and that money then goes into sectors targeted by Beijing, including transportation, logistical infrastructure, and a very efficient communication system, manufacturing plants, equipment, technology research. Really, the things that countries need to do in order to climb up the technology curve. The second reason is interest rates in China are artificially held low. They're repressed interest rates with highly negative real rates for much of the 2000s. And that represented a risk-adjusted credit spreads that were also artificially low. And that was a transfer, essentially, of economic gain from net savers to the borrowers. So it was cheaper to borrow, it was cheaper to produce this infrastructure, the technology, research, etc. And then the third reason mentioned in this article is China's hukou system for household registration, which limits the ability of workers to obtain social benefits and limits their legal rights with their employers. So the employers have had all the power in China versus the employees. So the article goes on to say there's two ways to boost consumer demand. Again, we want China to boost their consumer demand so that it can have sustainable growth. And the lesson for us I'm going to talk to is about the dangers of an engineered society. And the two ways to boost consumer demand is the first way is in the form of fiscal stimulus, which is what caused this initial drop. People were expecting a larger fiscal stimulus from China. It came in lower than what they were hoping for. And so that caused the stock market to drop. And one of the ways to stimulate the economy is, but it's not sustainable, is kind of what we did during COVID, which was provide these stimulus checks directly to the consumer. The second way, and the author argues, and I agree, is the sustainable way, is to gradually reverse the transfer so that household income begins to grow substantially faster than the overall GDP, because that has trailed because the benefits have gone to the employers. So Financial Times jumps in and is mentioning that China's market has had, what's the word that they used here? Vertiginous market rally. It means vertical, and such that it gives you, it was vertical so much so that it gives the investors vertigo, where you get dizzy looking down. So the Chinese market has had a really strong rise. And that drop, while it's the largest percentage drop year to date, the Chinese market has still been solid. But what happens with these engineered rallies, with these engineered economies, is things can start to swing. The Financial Times article goes on to say, but within hours, after Beijing policymakers failed to fulfill investor expectations of an announcement of deep, big, broad fiscal stimulus, the record-breaking rally slid into the biggest one-day drop in more than 4 years. And they go on to caution, and this is a good caution for all of us, if people are trying to make quick money right now, the inexperienced investor are bound to suffer losses. That was according to a person that the Financial Times interviewed. So Yahoo Finance goes on to say Asian stocks later in the week were mixed as markets await a Chinese briefing, and all attention is now going to the briefing of China's Ministry of Finance, which, as I record this, is scheduled for tomorrow in 24 hours. By the time I get this out, it will have already happened. But that's what investors are waiting for. Okay, so what's the lesson we can all learn? Let me pick this up. I'm here in New York City. I normally don't live in New York City, But let me pick this up. Let's go for a walk and let's talk about what the lesson is for all of us. By the way, behind me here you can see it's what I call the Wedge Building. Its official name is the Flatiron Building. I think it's beautiful. It's under a restoration. But what can we all learn from what's going on in China? You know, anything that can, first off, anything that can go up by 35% can go down by 35%. And if it went up by 35% in 9 months, here in the US stock market is up over, the S&P 500 is up about 30% over the last 12 months. And you know, anything that can go up by 30% in 12 months can also go down by 30% or 40% in 12 months. So what can we learn? We have to be careful when the drivers for economic growth are being overly engineered. Now, Jerome Powell and the Federal Open Markets Committee looks like they're going to pull off something that's very, very difficult to do. And that is to bring us in for a soft landing and avoid a recession as they worked to get inflation under control. In fact, as I record this just earlier this week, they announced the CPI numbers, the inflation numbers. It looks like inflation is back down towards 2.5%. Unemployment decreased by 0.1%. So it's kind of the Goldilocks situation, and I hope that they've pulled it off. But we need to be careful. There's been a lot of stimulus put into the economy. And when things get over-engineered, things can start swinging wildly. And when things start swinging wildly, think about a pencil, a vertical pencil, and a little bit of wobbling that pencil can take. But when things start moving wildly, things can tip over and big moves can happen in a short period of time. We saw that happen in Asia this week. Do I think that's going to happen in the US? I don't know, but what I do know is we're all wise to make sure that our long-term asset allocation is right. It's easy to be kind of lulled into this sense of, oh, I'm comfortable with a certain stock allocation. Well, of course we're comfortable when things are going up, but the question is, are we going to be comfortable if the market starts going down? And if we're not, the time to prepare for that is when the market's at all-time highs. It's a lot easier to make that adjustment now than it is after the market has started falling. And so I hope you found this video helpful. If you found this video helpful, I think you'll find this video up here helpful as well, which talks about what's the right time to think about retiring. Why retiring at 65 might be a big mistake. Thanks for watching this video, and I'll see you in the next one. Bye-bye.